So, welcome all of you on this Friday afternoon at the Duisenberg School of Finance, and also welcome on behalf of the Sustainable Finance Lab. The Duisenberg School and Sustainable Finance Lab, we share a similar mission, which is about shaping a sustainable financial industry. And I'm really happy that we organized this session together. Especially would like to thank Rens and Tilburg for reaching out to us and making this session possible. So my name is Bernd Jan Sikken. I'm the Director for Business and Research at the Duisenberg School. We also teach Sustainable Finance here. Today we're going to discuss the topic whether the financial crisis is over or not. People are becoming a little bit more optimistic, but we thought just before Christmas let's have a critical view on the financial system again. We've got two guest speakers. First of all, Steve Keen, Dr. Steve Keen, he told me, because he's now an independent writer and blogger, and formerly a professor at the University of Western,
wherever that is,
Sydney.
Yeah.
So,
University of Obsolete Technology.
So, Steve, he was one of the, let's say, most visionary people already predicting the financial crisis in December 2005, and he published a book in 2001 around debunking economics, also before the crisis. And he updated this book in 2011. So should the publication of a book be a leading indicator of a financial crisis, we may envision a financial crisis in 2018 again. After that we will have Lex Hoogtuin, who is a professor at the University of Amsterdam and also a visiting professor at the Duisenberg School, and he will share his personal perspective and also share with you whether we will have that crisis, yes or no. We aim to end the session at 5:15. The session will be moderated by Dirk Beesmer, who's from the University of Groningen and also a member of the Sustainable Finance Lab. And then after this session we will have a short drink. So with that I would like to end. Give a big applause to Steve Keen and wish you all a lively debate going forward. Thank you.
Thank you. Well, let's get going. I'm going to start with a rather ancient commentator on finance, and not somebody most people realise actually spoke about finance. This is an author from the 19th century, saying, talk about centralisation. The credit system constitutes enormous centralisation and gives this class of parasites, not exactly a favourable attitude to some people in the room here, not only the power to periodically despoil industrial capitalists, but to interfere in actual production in the most dangerous manner. And this gang knows nothing about production and effectively should have nothing to do with it. Any idea who said that? Indeed. You cheating, you probably came here before. Okay. It's not in the, you won't find this in the early work of Marx. You won't find it in the first volume of Capital. You've got to go further to the later work. This is volume 3. And he does quite a bit of detailed work about the nature of finance, and it's quite rich, intelligent work. But I think what we're experiencing now is that gang, as he called them, have been given the capacity to interfere with real production in a more dominant fashion than ever before, because conventional economic theory ignores the role of finance in macroeconomics and talks about equilibrium when we're an unstable system and leaves banks, debt and money out of their thinking. So I'm trying to bring those into economics. And a major part of that is the focus that I've had on the level of private debt. Now, conventional economists, if they obsess about anything, it's the level of public debt, and even there they get their spreadsheets wrong. Here I'm looking at private debt data stored by the Bank of International Settlements. I'm going to start with Japan's ratio of private debt to GDP. And the dotted line you can just see there near the end of the left-hand end of the graph is when we record Japan's slump as having begun, which is the very beginning of 1990. And you can see the level of private debt in Japan rose, hit a peak at about 2.25 times GDP, and then has fallen down to this level, risen again and fallen most recently. This is America, and their crisis began here. So we now have a similar level of debt, both in Japan, private debt, Japan in both America and Japan, and two more countries that are closer to home for you, Spain and Ireland. Okay, so the Netherlands would fit somewhere in the middle of those two. So we're talking a pattern which is repeated across the globe of an enormous level of private debt, rising and then reaching a peak and falling, sometime after the crisis, but a period now from going from rising debt to potentially falling private debt. Now, yes?
Steve, perhaps someone can adjust the projection because the top.
Oh, I see, yeah. That's beyond my control, I'm afraid. You're not seeing the title of the slides, but I'll tell you, this particular line says, far from foreseeing hubris before the crisis. Okay, so I want to show how little conventional economists were prepared for this crisis by the extent to which they thought they actually got rid of the possibility of crisis. This particular author does a fairly accurate summary of Marx, says that Marx argued that the system is inherently unstable and excessive accumulation of capital will lead to crises. And he then says growth theory, neoclassical growth theory, which has been empirically successful, which I think is an interesting claim in itself, says this is not true. This particular author is a Nobel Prize winner. It's Edward Prescott. And his argument about capitalism is that it is stable, and absent some change in technology or rules of the game, i.e. government policy, it converges to a constant growth path with the standard of living doubling every 40 years. Wrote that in 1999. Another Nobel Prize winner, talking about macroeconomics and saying that it was the body of knowledge that we thought would prevent the recurrence of another Great Depression. This is Robert Lucas giving his presidential address to the American Economic Association in 2003, the end of 2003, saying that the central problem of depression's prevention has been solved for many decades. So I'm not talking obscure academics, I'm talking mainstream people who get Nobel Prizes for developing conventional theory. And that's the extent to which they were unprepared for the crisis and indeed thought one couldn't happen. Another one, and that's saying ignoring problems in economics. This is, after the crisis occurred, the American government did something quite remarkable. They held a hearing into economic theory. And as part of that hearing, they asked V.V. Chari, who's a leading developer of DSGE modelling, what he thought about economic theory. And his argument was that if you had a sensible argument to make in macroeconomics, you can tell it using a dynamic, stochastic, general equilibrium model. So if you can't tell it when you're using those models, your story is incoherent. Okay? Now, at the very same hearing, Robert Solow was one of the guests to testify. And he developed neoclassical growth theory. And that is the basis of the DSGE models themselves. And he argued instead that he said he thinks economic theory should pass the smell test. This is smell right, but does it smell like something we don't like the smell of? Does it make sense? Pardon?
What is DSG?
Pardon?
What is DSG?
Robert Solow.
The model.
Oh,
Abbreviation there.
DSG stands for Dynamic Stochastic General Equilibrium, which is the dominant modelling framework that conventional economists use today. Have I answered the question? Or? It's a set of initials that implies that economic theory uses dynamic models that take account of shocks that talk about general systems that are in equilibrium. And my argument, only two of those words are true. They're equilibrium systems subject to stochastic shocks. They're not dynamic and they're not general, in my opinion. And strangely enough, I didn't expect to find Robert Solow arguing on the same side as me about economic theory. But he's a very, very staunch critic of these models that are constructed on his growth model. And in talking about these models, he said they take it for granted that the whole economy can be thought of as a single consistent dynasty carrying out a rationally designed long-term plan to serve by unexpected shocks, but adapting to those rapidly in a rational way. And he said that does not pass the smell test. He said people who use this theory justify it on the basis that we need to do models this way because of microeconomic theory, but he says that's a phony claim, and he's quite right. Conventional, high-quality economic research has proven these you can't aggregate from the micro level even to a single market, let alone macro. And Solow's well aware of that, and that's why he says we shouldn't be using these models, one of many reasons. He says advocates like Chari believe what they say, but he reckons they've lost their sense of smell altogether. Pardon me, I can say this now, but they don't know shit when they smell it. Okay, so what they've done is ignore, again we haven't got that, we're going to do without the titles I'm afraid, but it's just titles for the slides. They're ignoring the major issues in economics for a whole set of reasons that are really logic before you check the empirical data, a priori logic. And this is, Ben Bernanke explaining why he pretty much ignored Irving Fisher's debt deflation explanation for the Great Depression, saying that debt deflation is no more than a redistribution from one group, debtors, to another group, creditors. Now, talking about the smell test, I hope that smells off to you, because when somebody goes bankrupt, they don't redistribute back to the creditor, they fail to pay the creditor. So even at that level, there's not a redistribution going on. But he then said, absent implausibly large differences in spending tendencies between debtors and creditors, there should be no major macroeconomic impact out of a debt deflation. He then built a new Keynesian model that justified it to some extent. But what he didn't do was attempt to model or even consider Hyman Minsky's views. So he said Hyman Minsky and Kindleberger have argued for the inherent instability of the financial system, but in order to do so, have departed from the assumption of rational economic behaviour. Then he has a footnote, and the footnote says, I don't deny the possible importance of irrationality, but the best research strategy is to push rationality as far as it will go. Now, what to me means he's not an expert on the Great Depression. He's an expert on explanations of the Great Depression that are consistent with neoclassical theory. And since neoclassical theory says that capitalism can't have endemic crises, the only explanation is the butler did it. Somebody else shot capitalism. And who did he blame? The Federal Reserve. And I think if history repeats itself, he'll be blamed for causing this crisis by another neoclassical author in 70 years. But what I'd rather have than that happen is us actually develop what Minsky built. And that's a model in which Great Depressions can occur because they have occurred. And for that reason, we should be attempting to build economic models that can generate a depression. That was Minsky's starting point. He said, can a depression happen again? And if it hasn't happened, talking in 1982, why hasn't it happened? He said, those are the natural questions we should be asking ourselves, given this crisis, the absence of crisis in the 35 years between 1945 and when he wrote in 82. He said, to answer those questions, you have to have a model in which Great Depressions can occur. So fundamentally, he's saying if you have a model in which you can't get an endogenous crisis that is a depression, you haven't got a model of capitalism, which pretty much rules out the whole neoclassical paradigm. So he had to develop, given that challenge, a model that explained where the crisis came from, and that's what his financial instability hypothesis was. And it took serious notice of banks, debt and money right from the outset. So he began by saying, with his financial instability hypothesis, that the natural starting point for examining, and look what he's saying here, the relation between debt and income. That's the starting point of his analysis, not leaving finance out, but it's inherently in there. To take an economy with a cyclical past, so you've got to have a cyclical model, but it's now doing well. But immediately before this, there was a crisis when lots of organisations went bankrupt. So he said, in that aftermath to a crisis, but when you're doing well, people have a large margin for error. Any debt they take on, they're leaving a large margin in case things go wrong. So they won't face the prospect of bankruptcy. But because the economy has recovered, it becomes obvious that first of all, it was easy to pay those debts. It wasn't difficult for most people taking on debt through finance investment. And organisations that had a low margin for error, but therefore highly levered, they did better. They made a larger gain. So what happens over time is that people think, well, they had too high a margin for error. And therefore people start to take a lower margin for error, and therefore high levels of gearing, higher levels of debt become acceptable. And what that does is it increases the market price of capital assets. Rising debt causes rising asset prices, rising share prices, rising house prices, and increases investment. So you get a boom coming out of the economy. And that means that a period of tranquil growth leads to a period of speculative excess, ultimately. First of all, rising growth, and then speculative excess by the financial sector and by businesses and households in general. So his insight is that stable growth, which is this vision that neoclassical economics has about the nature of capitalism, that's inconsistent with the way we finance investment in a system with debt financed ownership of capital. If you can buy investment capital with debt, which we can, then this is going to be inconsistent with stable growth. And this is the very deep insight that separates Minsky from many other many other critics of capitalism. He's a critic and a fan of capitalism, as I am, both critic and fan. But a lot of critics expected capitalism to decline, declining rate of profit, underconsumption, etc., etc. Minsky's insight was the fundamental instability of capitalism is not downward but upward. He said the tendency to turn doing well into a speculative investment boom is the basic instability of a capitalist economy. That's the really, really deep insight in his vision. So I thought that was the best perspective I've ever seen on capitalism when I first read it back in '87. And I decided to make my task in my PhD building a mathematical model, because Minsky had tried to build a mathematical model and given up. And I took a cyclical model to begin with, which is Goodwin's growth cycle model. And that has two system states. It has the employment rate and the income distribution, because there's only two social classes. There are workers or capitalists in Goodwin's basic model. And I, by my work, added a third system state, which was the ratio of private debt to GDP. So that's my model included private debt, as Minsky's verbal model did. Now, pardon me, a bit of mathematics here, so you're going to get the old, oh, somebody actually likes the thought, great, in the front row. Okay. But the basic Goodwin model comes out of these two differential equations. Now, it looks like gobbledygook to those who don't like mathematics, but the first bit of that is the rate of change of employment. So 1 over lambda is the employment rate, so just to go backwards again, 1 over lambda dt is the percentage rate of change of employment. Now, the next bit looks again like gobbledygook, but that next bit is the growth rate. And these two bits are the sum of productivity and population growth. What that's saying is the employment rate will rise if the rate of economic growth exceeds the sum of technical change and population growth. And that's a factual statements, verbally factual statements. So the model actually boils down to two quite simple factual statements. That's the first one. The second one is the rate of change of workers' share will be the difference between workers' wage demands and labour productivity. If wage demands exceed labour productivity, workers get a larger share of output. The very simple verbal statements with mathematical logic behind them, but that's what's involved. So I took those and said, well, part of this is simplistic, because what Goodwin assumed was that capitalists invest all their profits. No, that's not true. They invest more than profits during a boom, less than profits during a slump. So I simply replaced that bit there, if I can get back to my mouse turning up. Where's it got to? There we go. That bit with a function, where investment was a function of the rate of profit. And then, because you could now invest more than profits during a boom and less during a slump, you had to store them somewhere and get that extra money from somewhere, and that's debt. So I said that net gross profit was output minus wages, but net profit is output minus wages minus interest in outstanding debt. And therefore the rate of change of debt is the gap between investment and net profits. Now I just hypothesised that. Much to my amazement, a few years later I found that Fama and French, who are two of the great advocates of the efficient markets hypothesis, did really good empirical work to establish that that's exactly the case you can find in the empirical data. Looking at the CompuStat database, aggregating all that data for American firms, they said debt is the residual variable in financing. Investment increases debt and higher earnings reduce it, which is exactly what I've got in that equation. So I then built the model and added the idea of a change in debt to the whole system, and it gave me ultimately a three-dimensional system. I had the first two equations I've already shown you, wages share of output and the employment ratio. They're quite simple to explain. This one is more complicated, but I won't try to explain it. I'll take you through its dynamics. And this is where I got the first of two results from the model that was a surprise. I didn't expect anything other than maybe being able to show a crisis in some circumstances, equilibrium convergence in others. But what it gave me was also a prediction that the crisis would be preceded by a period of apparent tranquility. And that was not in Minsky's verbal model. It's not something I expected to see. It was a surprise for the mathematical model. This is a bit of an emergent property going on here. And so when I simulated the model, what I got was this sort of pattern. That's a screen grab from the paper. Volatility galore in employment, then it settles down. And then the volatility starts happening again. And then finally a crisis that wipes out the whole economy. Wages share declining, which also happened, smoothly declining and then more volatile as well. Now, it doesn't make much sense there. It will when I show you the three-dimensional version where I've got the debt on the vertical axis. effectively you're being sucked up into a vortex of debt. And when I first showed this at my University of New South Wales when I was doing my PhD, one of my lovely econometrician I worked with, Eric Soe, said, "Steve, if you've caught anything that actually exists in real capitalism, we're in deep, deep trouble." Well, I didn't realise that I had, and I thought this phenomenon of the declining volatility before the crisis was a real surprise. So I finished with this rhetorical flourish saying we shouldn't regard the period of relative tranquility as anything other than a lull before the storm. Nice way to end his paper, I thought. Well, then the great moderation occurs. And conventional economists focusing on this stuff think they're doing really well in managing the economy, which is why for quite some time I thought maybe something more drastic is going to happen at some time. So just to show you that model running, this is a software package that I've designed with the help of INET and a Kickstarter campaign. And I'll bring it up and show you that model running. This is open source, so anybody who wants to download it can just go to SourceForge and download the system. And if I just make it a bit smaller so you can see a couple of the other graphs there and simulate this model, what you get is a period where the cycles in employment get smaller and cycles in wage share get smaller and workers get less of output. And then if you're looking at the two, you might think it's heading towards an equilibrium. But if you ignore the debt ratio here, that is also rising, as I argued in the paper. And as it goes on, those cycles of diminishing cycles start to become increasing cycles again. And then finally you get the breakdown that I showed you in that model. And this is a generic characteristic of the model. This is almost independent of the functional forms that I use in the parameters. Okay? It's something that is the nature of the model itself once I introduce that third dimension of debt. And then finally a total breakdown. Now the mathematical properties are now being explored by mathematicians, which I'm delighted by. I'm glad to have them diving in and doing the hard work for me that I couldn't do myself. So when you look at the economic data for 92 through to 2007, and then after that, it matches what I'm showing in this model at a qualitative level. This is the smooth unemployment rate and inflation rate for America from 1990 to 2010. And you have that pattern of declining cycles in unemployment and inflation, and then the crisis hits, unemployment skyrockets, inflation becomes deflation. So at a qualitative level, both components of the real world were captured by that incredibly simple model. And that's why I focused on the important role of the change in private debt. So going back to that data I showed you beforehand of the level of private debt, I'm looking at the annual change in private debt divided by GDP. That's Japan. You can see the crisis in Japan begins pretty much at the same time as the rate of growth of debt collapses. Same thing for America, looking over here now. And in a more messy way because of the volatility of the data, but the same thing in Spain and Ireland, and I'm sure in the Netherlands. The economy goes into a slump when the rate of growth of private debt slows down. Now, that wasn't the only thing I modelled in 1992, published in 95. I also included what if you had a government sector that held the line against unemployment, okay, by having a subsidy that rose if unemployment exceeded a target, I used 5% in this model, and that fell if it was below that target. And so I simply had the rate of change in government spending as a percentage of GDP being a function of this reaction to unemployment. So it's modelling automatic stabilisers, but automatic stabilisers that remain set on a target of 5%. And what I got was cyclical stability. Okay? So if the government did that, what my model argued would happen to the economy is this sort of behaviour. I'll make it, again, move it over so you can see the, well, you can just see the main graph there. We'll move it over just slightly. You got cycles that didn't lead to breakdown. So Minsky's definition of stability was not equilibrium, but having a cyclical system where the cycle didn't lead to a final breakdown. Now, of course, that's an economic government that held the line. And it's also, I was modelling an economy in which you don't have bankruptcy. So if you didn't have the private sector, if you had the private sector and no government to counter it, you could have, in my model, a runaway debt level where you never got a chance to pay the debt off, and therefore very compounded. So you end up with infinite debt and no employment. I didn't have governments modifying their target as they have done. They've moved further and further away from counter-cyclical policies. So if you have a government doing that, you'll have less stability than I showed in my model of the government sector. I didn't have the government making an exceptional response to the crisis, not just automatic stabilisers, but throwing money at the economy in panic, as they did in America. And I didn't have asset markets, so I haven't got Ponzi speculation turning up there either. There are lots of things the model omits. So I can't model the crisis, the economy after the crisis using this model. Extensions could get there, but I can show that a crisis can happen, and I did have the unexpected prediction that it would start with a period of great moderation. And I can show what happened if we didn't have bankruptcy, if we didn't have a government holding the line against unemployment, and if we didn't have strongly stimulatory policies, all of which we have had. So there are elements that I knew the model couldn't capture, and I wrote those caveats in the paper. So I said, if you had a government that holds the line, then you can diminish the chance of a depression. But what's actually happened is governments have shifted. They've accepted a high level of unemployment. They haven't tried to prevent unemployment like they did in the 50s and 60s. And that sort of behaviour, I said, would not attenuate the booms, as my model had government doing. So therefore, you'd still have booms as big as I had in the private sector simulation. So you'd still have debt-induced breakdowns, and increased government spending might prevent the smaller ones, but if you had a really large debt finance boom, then you'd have a prolonged slump afterwards. So, and therefore you'd also have governments running deficits. So I've covered all those issues as caveats to the model. So that to me is the vision I had back in 1995, and is why I came forward in 2005 making the warning. But I knew that to really move economics away from this obsession with ignoring debt, I'd have to build a model that made it possible to do financial modelling easily. And economists are not familiar with a whole range of techniques developed by engineers for modelling physical systems, things like Simulink, VisSim, Stellar, etc. Has anybody heard of those programs before in this audience? A minority, but they're what we should be using. But the trouble is, those models are great for modelling physical flows, but really inappropriate for financial, because in financial you have a plus in one system state and minus in another. You've got to make sure that happens all the time. There's nothing in the flowchart metaphor these programs use to enable you to do that checking. So I built Minsky as a software package as a way of doing that using the accountant standard double entry bookkeeping. Look across the rows, everything has to sum to zero. So I've got assets as a positive, liabilities and equities are negative, all rows sum to zero, flows are from a positive to a negative, and that makes it possible to build a complex model of the financial system, which I can show in that embedded simulation, without making any errors, and it's easy to understand the logic. So it then also generates the differential equations for you. So you can both self-document, and you can also check the consistency and logic that you've got there. And there are the generation of the equations in tech, and I can have as many banking sectors as you like, as many components of the banking sector. You can have the central bank, private banks, shadow banks, look at the accounts from the point of view of individual social classes, etc., etc. It handles all of that and models the physical elements as well. I press the B key. Never press B when you're giving a presentation. Okay. Now, why do economists ignore the debt? Well, a large part of it comes down to this model they have of lending they call loanable funds. And that's the greatest champion of that in the modern era has been Paul Krugman. This is Krugman explaining why he doesn't include banks and money in his model. So he does now have a model including debt. And he said, well, the overall level of debt makes no difference to net worth because one person's liability is another person's asset. He then says, it therefore follows that the level of debt matters only if the distribution matters. So the aggregate level you can ignore. It's just distribution that counts, and that's where he built his model of where debt matters. So he reckons you can ignore this trend in private debt in America, and I've now got it going back to 1945 and through to 2015, versus my argument that said that we'll have a crisis when the rate of growth of that debt slows down. 6 years after that happened, I'm still arguing against the mainstream that this is actually important. So to actually answer the question, you have to have a monetary model of capitalism, even if that's a monetary model of loanable funds, to see what the importance is. And I think we have to get rid of loanable funds. It has to go, because it's a myth. Central banks have been trying to tell, some central banks have been trying to tell economists for ages these things are, it's a nonsense vision of how banking actually operates. But the way that Krugman has modelled it in his DSGE model is to say that lending as a patient agent lends to an impatient agent, and banks can be ignored, they're just basically warehouses. His model, which includes debt, doesn't have banks, doesn't have money. But I'm now I'm going to embed his model in a bank, saying, well, if we use banks as warehouses, the lending would be from the patient agent to the impatient agent here, and that's all happening on the liability side of the banking sector. There's nothing happening on the asset side. That's the vision of loanable funds. Whereas I argue that banks actually do lend money, remarkable as that might sound, to non-banks. And therefore what's actually happening is the loans are occurring on the asset side and the money's turning up on the liability side. Still the same balance. Now, I want to show you what a difference that makes to the importance of money in macroeconomics. Because in the loanable funds, you can ignore it. Simply by saying banks lend to non-banks, the level of debt changes the level of money in the economy and therefore the level of economic activity. So I've embedded a little movie here where I make those changes in Minsky and watch it later, because I'll actually do it live here and I'll just show you the end positions instead. But in loanable funds, when I simulate changing the level of lending and changing the rate of repayment, nothing happens to GDP. So the debt ratio, which can go up and down as you can see there, is irrelevant to GDP, which is just flatlining. When I make those simple changes to put lending on the asset side of the banking sector, then if I change the rate of lending, I change the level of economic activity. Debt and economic activity are interlinked. So I'll just show you that with a quick simulation. That's the movie, which I won't run because it takes a bit too much time and I haven't got the sound linked up. But this is the loanable funds model. And if I now simulate this and then have lending happening more rapidly, then the debt ratio rises, which is the level of debt rises, the red line there. GDP doesn't change. If I have repayment happening more slowly, debt rises even further and can exceed GDP. If people repay much more rapidly, if lenders lend much more slowly, debt level falls. It's all irrelevant. It doesn't affect the macroeconomy. And that's the vision, the a priori vision of banking, that means is why people like Krugman don't consider banks to be important. But simply by shuffling the loan onto the asset side of the banking sector, if I then run this model, two things happen. First of all, there's growing amount of money in the economy, which didn't happen in the other model. Secondly, if lending happens much more slowly, both the level of debt drops and so does economic activity. So changes in what happens in lending have a dramatic effect upon the nature of the economy. You can't ignore banks' debt and money. All it takes. Exactly the same models, except that I'm saying banks lend money in one and banks don't lend money in the other. So if we live in a planet where banks don't lend money, Krugman would be right. We don't live on that planet. So we can have debt-driven crises, and one thing I've been trying to do, as well as bringing banking in there, you need to have banking to have money to have prices. So this is an incomplete model. I know it's not completely right, but when I include prices and using a banking system embedded in a physical model, I get the one-sided crisis we actually saw. I've got to improve this model and make it fully consistent, but to simulate and show you how it behaves, you have the same rising level of debt as I showed in the other model, the same diminishing cycles in employment and inflation here, but what is different is the crisis is one-sided. When the crisis begins, there's a blowout in debt and a collapse in employment, and it comes out of the blue. So that's what we actually went through. That's what we need to capture and explain fully. And that's why I began to warn of the crisis back in December of 2005. Now, after the crisis, politicians and economists are still fixated on public debt. So let's take a look at public debt. This is data on America going back to 1791 on the level of public debt. And plenty of economists will tell you that that's the highest level in peacetime of public debt. But they are ignoring this, which is private debt. And that is the highest level ever. And the downturn in that is what caused the rise in public debt. So we're focusing upon the symptom rather than the cause of the crisis. So what we have is a collapse in aggregate demand because of a collapse in the rate of growth of private debt. And when you graph the change in debt against the level of unemployment, you get a correlation which, according to conventional theory, should be either zero or insignificant. I get minus 0.9 over 20-something years. And I get minus 0.51 over 1.5 centuries. So it's a long way from insignificant. If we're in empirical science, we should be attempting to explain this from the outset rather than ignoring it in an a priori way. And notice how the revival, the fall in unemployment now, has coincided with debt turning around from diminishing to rising once more. So part of the reason why the American economy is recovering is because it's re-leveraging. And my feeling is we can't have a long recovery because we're re-leveraging from a historically unprecedented level of debt. So the length of time that can go on for will be limited compared to any other post-war recovery, and therefore we're going to have sluggish growth because of that unprecedented level of debt. This is now looking at private debt for the household sector and the business sector to make the point that it's not actually the household sector that's borrowing yet, it's actually the business sector that began borrowing money again in 2010. But again, we're talking about a ratio of debt to GDP that simply hasn't been experienced before. So to have this lead to another debt finance revival, it's not going to last as long as the last one. And it's also important to use credit as an indicator of where the economy's turning points are, because I've argued so far that change in debt contributes to the level of economic activity. That means the acceleration of debt contributes to the change in economic activity. And this is showing the correlation between acceleration of debt and change in employment since 1990, a 0.92 correlation. That's a fair distance from zero. The same thing with margin debt, and this is quite scary. I didn't expect to show you the chart I'm going to show you. I really got a surprise when I plotted this because my correlations are between acceleration of debt and change in asset prices. I didn't expect to see a correlation between the level of margin debt and the level of the S&P 500 deflated by the CPI. That's what the data shows. Red line is margin debt as percentage of GDP. The blue line is the S&P 500 deflated by the CPI. And notice that for the whole period from 1963 to 1995, margin debt never exceeded 1% of GDP. Then up to 3% virtually. Virtually 3%, again, at each of the recent bubbles we've had in the stock market. And when I take a look at that acceleration relationship, I'm seeing the sign of beginning of deceleration in margin debt, which is one of my little warning signs to say, well, maybe 2014 won't be such a crash hot year for the stock market as 2013 was. There's plenty of other headwinds as well you can point to too. So my vision overall is we're repeating the 1930s, which is not a good decade to try to repeat. If you're going to have a Groundhog Day, don't choose the 1930s or Groundhog decade. So we know debt deflation caused the crisis. I'm going to show you the empirical data now. This is the decline this is nominal GDP and its dramatic fall. Small fall in debt, which actually, in my argument, caused the whole process, and a rise in public debt to compensate, but nothing like the rise in public debt we've had this time round. One reason why the crisis is so much deeper is the government sector is effectively 6 times as big now as it was during the Great Depression. So the automatic stabilisers of the government sector are far larger, including, of course, unemployment benefits, which virtually didn't exist back in the Great Depression. The trouble about the Great Depression is it wasn't ended by Roosevelt. It was ended by another little bloke on the other side of the Atlantic with a funny mustache. And then particularly his mates in Japan, because if you take a look at the level of government spending in America, look when it takes off. Pearl Harbor. Okay? They didn't start drastically gearing up spending, huge level of government debt, and it drove GDP up as well. So you had an incredible level of growth of GDP, mainly measuring tanks and guns. Okay, a bit more deleveraging by the private sector because they couldn't not delever. There's so much public money being thrown at them to build the weaponry. But then, at the end of World War II, we have a dramatically delevered private sector with a far lower level of debt than anything in the previous 30 or 40 years, which meant you had industrial capital that got all the debt finance it needed and no more, and it had very little financial charge on its cash flow, and could therefore invest and innovate in the way that American capitalism did in the 50s and 60s. But that rising level of debt ultimately got us back to a situation where we still have a level of debt that exceeds the worst of the Great Depression. So my vision for the future is we're turning Japanese. You know that song by the Vapors? Great song, terrible idea. We're emulating what Japan did 20 years after Japan did it. They had a depression after a debt-fueled speculative binge. We've done the same thing. And in the aftermath, the debt financing you want to have, where firms invest more than retained earnings is restrained by the sheer level of business debt and by consumers who are carrying more debt than will enable them to consume. So you therefore get slow growth because there's low investment, you're only investing retained earnings, if that, you're not doing debt financed investment, and low demand, you don't see much potential for sales out there. And governments at the same time are obsessing about lowering government debt when that's not the problem. Okay? The problem is private debt. So I expect to see, unless we have a real shift in the game, decades of low growth with occasional spurts in asset prices, particularly when central banks try to boost them, as Bernanke's central bank has been doing. And revivals will happen, but they may well be cut short by the government sector cutting back on spending. So we have to reduce the level of private debt, which is how we got out of the Great Depression, but not by another world war. That we can't afford. So for economics itself, the sort of work that I do and that Dirk does is still being derided by conventional economists. Okay? But we're starting to get some recognition. So I have to acknowledge Nick Rowe, who writes a blog called Worthwhile Canadian Initiative, for attempting to put my vision of why debt matters into a framework that neoclassical economists can understand. He got it right. He said aggregate nominal income equals expected nominal income plus the new money created by the banking sector. And he said none of that violates any national accounting identity. He did a very good job of rephrasing it in a way that a neoclassical economist can understand. And that may be why, I don't know, I'm looking forward to finding out, while Paul Krugman has made a massive change of his tune just last week when he said debt was rising by 2% of GDP annually. That's actually massively understating the rise in debt. He said rising by 2% annually, that's not going to happen in future, so a naive calculation says a 2% reduction in demand. That contradicts loanable funds. So I'm intrigued to see how he copes with that. Now, even if you contradict loanable funds, you've also got to give away equilibrium. And again, as Nick said, the process I'm talking about is a disequilibrium one. You can't understand it in an equilibrium way. And I'll finish with one more slide before Dirk kicks me out. And that is say, what should economics be doing? We need real reform. The stuff the Manchester students are arguing for now. And we have to abandon what is fundamentally, though I think unintentionally in some ways, an ideological vision. Equilibrium is a nice place to be, so we're told. It's got pejorative terms to it. Barter gets rid of all those hassles of banks. Rational agents who can prophesise the future, excuse me, but if we could all foresee the future, we'd never make a mistake, would we? And a classless vision of capitalism, where there's no social conflict and everything can be made totally optimal, and a vision which leaves out thermodynamics and the ecology. And we need to replace that with one which is dynamic, which talks about non-equilibrium, and the positive sides of non-equilibrium. Innovation comes out of non-equilibrium. Monetary, because we can't have capitalism without money and banks and debt, where expectations are formed with an uncertain future, where social class conflict exists, but so does symbiotic relationships. And I really believe workers and industrial capitalists have a symbiotic relationship. It's financial capital and industrial capital where that can turn into a parasitic one. And we're aware of entropy, energy, and ecology. And we're a long, long way from getting there. Thank you very much.
Thank you very much, Steve, for an inspiring and high-speed talk. There's a book by a famous Groningen psychologist, Duisenberg, Why Life Speeds Up as You Grow Older. There is a famous book titled Why Life Speeds Up as You Grow Older.
And I just get faster as I get older.
So before I invite Lex to respond, let me ask one question that may be burning in the back of your minds, perhaps even the front. I spend a lot of time talking with my students about causality. Now you showed us graphs of correlations between all sorts of debt and the S&P 500 or GDP. And there's a famous saying by the economist Joan Robinson where business goes, finance follows. And by that she meant to say it's nonsense to be looking at what the financial sector is doing and then infer what's happening in the economy from there. Actually, you need to be looking at the so-called fundamentals, which she called business in this one word. She captured fundamentals and said, if you look at what enterprise is doing, the money to finance it will be forthcoming either through the markets or through banks, and therefore you shouldn't be focusing too much on financial things. You should focus on what economists call the real sector, although the financial sector is surprisingly real as well. So, how do you know, when you show us these 90% correlations, how do you know that the causality is actually from debt to growth and not, as Joan Robertson believed, from growth to debt?
I think because Schumpeter gives the argument there that you won't get the growth without the debt to let you expand. If you didn't have the financial sector being able to provide that money to enable entrepreneurs to invest, then you wouldn't have that growth beyond the current constraints of the economy. The alternative to an economy where growth in the money supply occurs is falling prices.
But let me give you
Deflation.
an analogy,
Yeah.
right? So we need oxygen to do whatever we want to do. And we might monitor the amount of oxygen that we breathe and then say that is the cause of our actions. Whereas an alternative vision is, well, of course there's a correlation to how hard we breathe and how hard we run, for instance. But that doesn't explain why we start running.
Oh yeah, but that's
that may be because we are
that again,
afraid of it.
what I've got in the model is I have businesses deciding to invest more than their profits, and the banking sector accommodates that demand, which is actually precisely what you're saying. The businesses are driving the level of debt by that willingness to do it. What I include is, I haven't actually included in this model I've shown you tonight, I don't have banks going out there and saying, would you like a credit card with that, as they actually do. So I haven't got them pushing the debt, I've got them simply supplying what the banks demand. But because they supply that debt, they cannot but increase the level of debt the firms have. So the firm's willingness to take on that debt initially during a boom means they've got to service it during a slump. And that's the fundamental dynamic that I'm capturing there.
Okay. I'm sure this will be a topic that perhaps some in the public will take up, but not before I invite Lex Hoogduin to respond. Let me say that in addition to being a professor at the UvA, Lex is also professor of complexity and uncertainty in financial markets at my university, University of Groningen. So what's more appropriate, I would almost say, to this talk? Lex, please respond.
Well, good afternoon, and thank you, Steve, for this very inspiring and indeed high-speed presentation. I had the benefit of having received the presentation already yesterday, so for me the speed was perhaps a little bit less than for the others. Dirk, also thank you for the introduction. I think I have 10 minutes. It's an impossible task to do justice to Steve's presentation and to my own comments, to be honest, in 10 minutes. Yeah. First of all, I think it is important to tell you from which background I will be making my comments. Because my first point is I'm an intellectual friend of Steve. I'm an intellectual friend because my PhD is about uncertainty and monetary economics. And I did my PhD in Groningen in the middle of the 1980s, I think around the time that you started to work.
I was starting, yeah.
On the Minsky model, I was also starting, and I did my PhD with Jan Krehel, who you perhaps know.
Yeah.
And Jan Krehel is one of the, I would call, second generation post-Keynesians.
Yeah, I must say his book, Post-Keynesian Economic Theory, is what I taught myself a post-Keynesian approach from, the golden age approach of Joan Robinson.
Yeah, he was a pupil of Jane Robinson and Joan Robinson and was one of the starters of the post-Keynesian tradition. Minsky also one of them. And so I did my PhD in that direction, and life has never been the same after that. So I'm convinced of the criticism, let's say, of the post-Keynesian tradition, and I fully buy, let's say, all the criticisms that Steve has made today, and there are more in his books on neoclassical and a new Keynesian economics. For me, I think there are two basic reasons why we need a new paradigm, or a more dominant other paradigm than the new Keynesian neoclassical tradition. I think there are two things. One is that there's an inconsistency, and the second thing is there is a highly unrealistic wrong assumption in, let's say, traditional macroeconomics. The inconsistency has to do with knowledge, and that's the uncertainty point.
Yeah.
And that's the point that the post-Keynesians emphasize very much. They argue, and I think rightly so, that Keynes' theory was about uncertainty, and that Keynes argued that uncertainty causes, in the end, that an economy does not automatically yield a full employment equilibrium. And uncertainty in Keynes' view, I cannot elaborate too much, is very much linked to the role of finance, the role of money, the role of liquidity in the economy. Now, in the uncertainty means that there are things that we simply don't know, and that you cannot represent by using quantitative probabilities, stochastics, like we have in all traditional theory. So the knowledge assumption in traditional neoclassical theory doesn't work. It's inconsistent because there are simply things that you cannot know. And the most important thing is we cannot know now what we will discover in the future. And there are many decisions that we have to take now that are dependent in the end on what will happen in the future. So logically, we have to take a lot of decisions under uncertainty. The second thing is that, the second wrong assumption is that traditional theory assumes that there's a lot of heterogeneity in the model. We work with representative agents, and we do not take into account that the economy and the financial system is a complex system, in the sense that it depends on a dispersion of a lot of knowledge, and that the core characteristics is that people are, and agents are different. So these are the reasons why we need, very briefly, why we need a different paradigm, and there are different traditions trying to offer such a paradigm, and I think it's fair to say that Steve is indeed one of the people that is on the forefront of, let's say, what I would call the post-Keynesian complexity paradigm that is emerging, perhaps. I think it is true if you look at, you take uncertainty seriously and you take complexity seriously. It is true that one of the hypotheses about the capitalist economy is that it is indeed inherently unstable. And that is then rooted in, I cannot elaborate on that, indeed in the uncertainty under which we have to take decisions. And secondly, it has to do with human nature that has evolved over many centuries, and can be taken as given in our explanations. Finance plays a role, but finance itself is a response to uncertainty. Money is a response to uncertainty. Markets are a response to uncertainty, are ways to deal that people have discovered to deal with uncertainty. So the root cause of the instability is not finance itself, but finance is a vehicle because it's an imperfect response to instability. So this all is very much, let's say, supporting Steve's position. But now let me also shoot some friendly fire, which can be dangerous as well, perhaps. But let me nevertheless do it, because I think what we need is not only, let's say, to develop what I would call real macro. So that's macro that indeed shows behavior that cannot simply be derived from aggregating micro behavior. We need a synergy and integration of macro and finance. It's driven apart, whereas Keynes I think you can read Keynes as trying to integrate money and finance on the one hand and the real sector on the other hand. For Keynes, the question that Dirk raised would have been a very strange question in a way, because what Keynes tried to achieve was to argue that these things cannot be disentangled. There's one monetary real economy, and they are integrated, and you cannot explain what is happening in the real economy without knowing what is happening in the money side. It's one integrated thing. So we have to go back, as it were, to Keynes, to Schumpeter, to Minsky, to integrate them, but should not stop there. I think we should also look at Hayek, because the complexity issue, which is again popular now in economics, was effectively raised by Hayek already in the 1930s. And the way Hayek complexity defined is that a system is complex if it's impossible to collect all the data and information that you need to describe a state of that system at one point in time. You can never centralize that, because you have this dispersed knowledge, you have this heterogeneity, and it's simply impossible. And Hayek very much developed his thinking about the economy from that perspective. And that leads to a number of very interesting and important insights. Again, I have no time to go all too deeply into that, but one of the things that he, I think, forcefully proved on was that in an economy, it is not possible in a macroeconomy to make very detailed, precise forecasts. It's one of the mistakes that economists have been made, is that they try to be like the natural sciences, that they were able to forecast in rather great detail what was happening. And another thing that he emphasized, and that's the other perspective that we didn't focus on this afternoon, but where also Keynes focused on, was that he of course had a theory about instability. And essentially he had a theory why we had instability. But he was as curious why an economy was far more stable than you would expect. But if you look at the actual stability in the data, there's a lot of stability. Even nowadays, if you look at for instance, the fluctuations in Dutch GDP, in 2017, we are back at where we were in 2007. If you then look at the data, of course we feel like a lot of instability because it was far more stable. But still, in absolute terms, this is not huge. This is not huge instability. This is not what we saw in Steve's model, where we have these huge fluctuations. This is not what we see in the data. Therefore, Steve was careful to say qualitatively, I can forecast what was happening. It was not. You cannot. In quantitative terms, what we have to explain how it is possible that market economies are so stable and they can generate so much stability. And what Hayek adds there is that we have to take into account the norms, the ethics, the laws that you have in an economy, because they provide a framework in which people can operate and give some degree of predictability in their own environment. Again, don't have the time to elaborate, but if you take this seriously and combine it with the earlier part, I think this has far-reaching implications for the methodology and the pretense of what economics can tell us. And in that sense, I think Steve doesn't go far enough. Doesn't go far enough at all, because we need an integrated model not only of money and finance, but we have to deal with indeed the ethical part of the economy, the norms, the institutions, and so on. Before I close, I really want to say something about the model that Steve has presented. To me, again, it's fascinating, it's interesting, but if I have to shoot at it, my shot would be that Steve is doing what he accuses sometimes neoclassical economics of doing, having Hamlet without a prince. And this is a model where we have handled without a quiz, because it's a deterministic model. There's not even stochastics in it. It's a deterministic model, so there's no uncertainty in it at all. What I'm curious at, he didn't discuss it today, but if you continue to run the model, what would happen after? What would happen afterwards? It doesn't tell us what happens after the thing starts to become violent. Steve says it breaks down. What does breakdown mean? If I look at the fluctuations here, and how then does the economy respond? So there's no real uncertainty in it, and if that's, for me, that's the key issue, and that's what makes finance important. So this is my main criticism of the model, and finally, again, I don't think Steve said it. I think it's an interesting thing to discuss. It was in the presentation, or I read it somewhere. Steve says somewhere the best thing that we need is at the moment is a debt write-off.
Yeah.
But it's probably it won't happen. And I think he is right. It will not happen. My question is, doesn't it happen because we have all those stupid neoclassical economists around, or whether there are other things that don't make it happen, and perhaps that could it will not happen. For instance, fairness, what it would mean, the overall social and economic order, again, is based on certain norms and things that we expect. And I think that in many cases, people would find it very unfair if they have to pay a part of the debt of somebody else. It's a matter of not fairness, and it may well, in the end, if we start to go that road, it could well very much destabilize the economy, and the cure could be worse than the disease. Certainly for the Netherlands, where I would argue that we do not have a general debt problem at all. But there I cannot.
Okay, thank you very much, Lex Hoogda. I suggest before we move to the general question answer that Steve responds to this one point, which is that your model is deterministic. Steve,
Yeah.
and I urge you
Can I actually
to...
get the screen?
Excuse me, I urge you to keep it within 1 minute because these people are really waiting to ask their questions.
Okay. If you can bring the screen back up, is that possible?
That is
Yeah. Because I want to show a totally deterministic model, which is totally uncertain. Because I think there's a false dichotomy in the way people approach these models. I think if you're deterministic, therefore you must have certainty. And that's the vision that even some post-Keynesians push, which I'm trying to persuade them out of it. So this is a totally deterministic model coming up in a moment. Once the projector works, here we go. Okay, you're beginning to see it there. This is Lorenz's model of the weather system. I'm now running the model in equilibrium. I've got 3 variables, x, y, and z, and 3 constants, a, b, and c. That's all there is to it. And in equilibrium, you can see what an exciting system it is, and that looks just like yesterday's weather, doesn't it? And tomorrow's, for that matter. If I just give one instantaneous shock, and then go back to no shock at all, that's a deterministic model. But you cannot predict its future, because any information you have about it will not be absolutely precise now. And the information you have there now decays exponentially over time. It's where the idea of the butterfly effect comes from, and so on. So deterministic model does not mean certainty. Okay? Deterministic linear model does. Deterministic non-linear, above 3 dimensions, you can have a system where you can know the system almost precisely and have no capacity to predict it after a finite period of time. So that's, if I could add the stochastic to it, make it more uncertain. But the uncertainty is in the non-linearity of the system, not in the fact that it's deterministic.
The uncertainty is in that you cannot know the precise starting, starting point. And indeed, you model the weather. You do not model an economy where people have to
That's an additional, that's the
I
other
think,
thing.
I think that's fundamental, because
That's-
that's what
Yeah.
leads to demand for liquidity.
And that's
keep
where,
the
like-
options open, that leads to trying to build stable institutions and so on and so forth. Nothing in there generates, let's say, the institution formation. Like
Yeah, and that's essential to happen as well. So but you can start from a system which is non-ergodic, even though it's deterministic. And that's something which a lot of conventional post-Keynesian economists don't realise, let alone the neoclassicals. So ergodic, not uncertain models are feasible. And of course, in reality, we have people reacting in ways we simply can't pick. Yeah, on top of that.
Right.
I think, and that's crucial, because people have to deal with
Yeah.
it. So it cannot be removed, and we have survived all those decades or centuries
Yeah.
with this uncertainty, and managed to grow and managed to have a relatively stable environment. And how
Right, it's time for questions and answers. So may I invite you, do you each have a microphone, or you can speak
I
up
think I
simply?
can talk loudly,
Yeah. So
not slowly but loudly.
raise your hand if you want to ask a question or make a short comment. Questions preferably. Tell who you are, where you're from if you want to.
Do you want to pass
please.
the microphone over? That's might be easy there. Yeah.
And then also who your question is to. That's good, yeah.
I'm Peter van Rood, I'm here on personal title. My question is, you talk about debt being an issue, but at the same time, of course, it is eventually globally
Yeah.
something where debt equals the assets of somebody else. Chinese assets, US debt, for instance. Aren't you actually more probably into an area of where we see a shift in wealth being transferred from one region to another, which from a global macro perspective actually is just a change of state of affairs, more than that it is about the demise of the whole global sort of economy. In other words, haven't you actually looked at a specific segment rather than the total picture when you looked at the issue of debt in global economy?
Well, let me repeat the question.
Yeah.
I will ask to repeat the question so everybody.
And so my hearing helps
Hear
as
it.
well.
The question here is, when you look at debt, you're basically looking at part of a larger process where wealth may be transferred across the world, for instance, from Asia or from the West to Asia in this instance. So aren't we looking at just a part of the picture and thereby missing the larger picture?
In effect, I'm modelling the planet as a single economy, so I'm not looking at the impact of breaking into separate regions. And at that level, because we don't trade with Mars, you can say that the Earth is a self-contained system. And I'm showing what would happen if we didn't have national boundaries. Because we do have national boundaries, what you can then have is a sort of dichotomy we're seeing between America and China. And to put a perspective on that, the conventional neoclassical vision is that what caused the crisis was a glut of savings in China, which then had to be invested over in the West. That's the exact opposite of what I see as the pattern. We had a glut of debt creation in America, which meant Americans had spending power coming out of that debt, large part of which went into asset purchase in America, but it also went into buying Chinese goods to stock those houses. And therefore, the creation of debt in America created the savings of China that then had to be, with the Chinese having to quarantine the impact of that on their own economy, they then go and buy American bonds to stop that growth in the money supply that would have otherwise driven up the domestic inflation. So you get those sorts of dynamics coming out of it, and you can analyse it from the point of view that I've been using here.
I'm going to be quite strict with the microphone. Next, a short comment on this question.
No, I fully agree with what
And,
this.
yeah.
Britain we should be able to do without the mic.
Okay, I fully agree with the with Steve's explanation of, let's say, what caused the financial crisis of 2007, 2008. One thing to add: it were not the Chinese that were financing the U.S. boom, were the Europeans.
Right. We're moving to the next question in the very back, so speak up, please.
Yes, first of all, thank you very much for an inspiring lecture.
Thank you.
I must say that after my master's in Maastricht, mainly because I had more questions than answers afterwards, I have a much better understanding thanks to your research, what's going on. My question is actually twofold. First one is slightly theoretical, in the the sense that as you are sticking to double entry bookkeeping, it's kind of unclear, and I think also your friend Michael Hudson emphasizes it, where does the interest come from? Which I think is a question that arises a lot of times. So when loans, when loans create deposits, where does the interest come from? And the second point is, I was wondering if you could comment on what you think is the problem in the Eurozone, and especially if you agree with the MMT perspective.
Okay, interesting
Right,
question.
so let me repeat the questions in case for the general audience.
You
There's
okay? Well, that was quite clearly stated. Even I could understand with my bad hearing. So, okay. So it's a question about where does the interest come from, and what I think about the Eurozone and MMT interpretations as well. Interest is
what is MMT?
MMT stands for Modern Monetary Theory, and it's it's a group of economists who are similar economic orientation to the two of us, being post-Keynesian in their background, but they're focusing more on the role of government capacity to create money and thereby stimulate the economy. I'm focusing more on the private sector and what it does to cause crises. So we're both trying to develop a monetary theory of economics. But my analogy is always the blind men and the elephant. You know? They've got hold of the trunk, I've got hold of one of the legs. We're still describing the same animal, I'll be getting there. So we're both on the same side of thinking you have to have a monetary analysis of capitalism. But there's a different approach, emphasis they make on what the government can do that makes the system work better, whereas my emphasis is what the private sector does that make it work worse. So that's where those two schools sit. The point about where does the interest come from? If you borrow money, you might borrow $100 and the bank charges you 5%, you've got to pay back $105. Where does that $5 come from? That is a classic stock flow confusion, which is, I've seen, it's not just people on the street who make it. Graziani, whose vision of monetary economy is what really gave me the capacity to build the models that I build today, made the same stock flow confusion. If you ask somebody how much do you owe the bank, they will say $100. They won't say $100 per year. Okay, so your debt is a stock, but the interest that you're charged on that debt is a rate of payment of money per unit of time. So the bank says you want to pay $5 interest on that loan. They mean $5 per year. So there's a stock of loans which generates the flow of money that you've got to pay to the bank. Now you borrow that money because you want to create a stock of turnover of your own business. So you might borrow $100, and if you then use that to hire workers, buy goods and sell the goods to other people who then buy them back off you, and you've got a circulation going on, that $100 stock of money, talking in terms of the velocity of circulation, might generate $300 worth of turnover over a year. Now if you spend 250 of those dollars hiring workers and buying goods from other capitalists, you've got a $50 profit, out of which the bank, which is a profit per year, and the bank wants you to pay $5 to them. So you pay them $5, you've got $45 net profit. There's no problem. The interest comes out of the turnover of the money. So paying the interest is not inherently impossible. And that's one of the mistakes that were made by stock flow confusion, which is why it's so important to work in dynamics and economics, because as Koleski once described to Joan Robinson, bumped into her walking across Cambridge and said he finally worked out what economics is. And Koleski was an engineer who then did economics in the 30s. He said, it's the science of confusing stocks with flows. Now, you asked on the euro. Yeah. I think the euro, you could not have done
I go on the other channel. just very
I wasn't going to strangle you when you were watching.
very briefly, before we turn back to Steve on the euro. On MMT, I think MMT is indeed a very interesting stream of thinking in economics, and what we should aim for and what we should try to achieve is an integration of the type of thinking of Steve and MMT.
Yeah.
Because where Steve very much focuses on private debt, and rightly so, he more or less, and now exaggerate, I'm aware, he more or less ignores public debt. Where there's a lot of focus in the MMT on the role of the government in providing stable money, and the importance of the government in providing stability. And I think we should aim at trying to integrate those two, and they may change the conclusions drawn from both.
Yeah, I completely agree with that. We have to integrate the views, yeah. It takes time. And he's taken the time off us, so we can't use it.
Okay, briefly, is this microphone doing anything?
No.
I'll say no. Can you all shut up? So it's a symbolic thing of who's talking. Steve will very briefly say something about the euro. He's promised to be brief.
Okay.
And then we go to the next question there. I ask everyone asking a question to stand up, because then we can hear you that much better.
Yeah,
Thank you
yeah.
very much.
Okay. I think the euro couldn't be a worse, the European Union couldn't have done a worse policy if it tried by imposing austerity. Because what I've shown, and what's been shown by the American experience, is government spending can attenuate the seriousness of a downturn, even if it's not to the scale of what the MMT group would like it to be. So America's got an unemployment rate running about the 7% level, Europe's 12 plus, and you've got some parts of Europe running 26%. It's a horrifically bad empirical comparison of the two countries, and that's something which not just MMT but Paul Krugman's on the same side, saying austerity has been an absolute disaster. So the Maastricht Treaty was a disaster waiting to happen, and because the European politicians can't break out of that insane treaty and either break the euro or bring in fiscal union, you're stuck with a far worse situation in Europe than you should have otherwise had.
Thank you.
I've got a simple question. Does it matter what the debt, the private debt, is used for?
Oh yeah.
So the question is, does it matter what the debt is?
I recommend you all go and see a movie called Galaxy Quest, and you guess which character he's emulating right now. It's a very funny movie. Thank you. It does matter, because if you borrow the money to build factories, then at least you've increased the capacity of the economy to pay that debt at a later stage, and you've increased physical resources. If you borrow it to speculate on rising house prices, as you've done in Holland, and Australians have done as well, and Americans too, it's a waste of time. It actually just builds you additional debt without the capacity to service that debt. It's a catastrophic way to behave, but it's the easiest way for politicians and bankers to behave. We need to break out of that trap. But even so, with the crisis I've shown you there is actually what you might call a Schumpeterian crisis, because all the borrowing in that particular model is for building productive capacity, and you could still have a debt crisis. When I extend the model to include what I call Ponzi investing, where people borrow because of the rate of growth of the economy and gamble on asset prices, therefore adding to debt without adding to productive capacity, it's a worse outcome than that model.
Okay. 1, 2, and 3, and 4.
Okay.
Remember the order yourself, please.
Now it's Hans de Geus. I have a question on the relation between interest and growth.
Sorry, Hans, is your question to Steve or to Lex?
To both.
Yeah.
Is that
Okay.
possible? Well, whoever. Does a positive interest imply you need growth? And on the other hand, if there's if there's negative growth, does that mean the system will break down?
Yeah.
So the two ways.
Yeah.
So sorry.
Yeah.
Lex is going first. The question is, correct me if I'm wrong, the first part I'm not sure, does the existence of interest imply growth? So is
The need
actually
for growth?
the
Yeah.
existence of interest implying the need for growth in an economic system?
Yes.
Very widely debated issue. And does the system break down when there's negative growth?
Exactly, with
Yes.
positive interest.
Those are two questions, and they
Yeah.
are related. Lex. Or you may hand over the microphone if you're...
You can have positive interest without a growing economy. I did a very simple paper, which I'm now going to make some corrections to, but it's called Solving the Paradox of Monetary Profits. And in that I simply had a fixed amount of debt, positive interest, and positive incomes for workers, capitalists and bankers. And the system mathematically is quite self-sustaining. So you don't, it's not the positive interest that gives you growth in the level of debt and growth in the economy. It's lending, it's exceeding repayments. So a growing level of money in the economy that happens there. Therefore you don't need to have a negative interest rate if you have a declining economy or a stationary state, because capitalism's tendency is always to grow. There's no avoiding that particular tendency to grow and have crises. That's capitalism's bottom line, I think.
That's a very short answer, thank you. Bas? Yeah. Who was next?
Yes, as a non-economist, looking at the economy, I'm hearing both of you say what is actually necessary is debt jubilee, but it's not
Yes.
going to happen.
Yeah.
So the question then is, what will happen if we don't do that? What are the long-term? I know that you yourself are highly critical of people trying to predict the rationality and or the prophetic of the future, but this cannot go on forever. So what will eventually happen with this debt? And how can we actually push this debt jubilee higher on the agenda? Because there are a lot of students here, a lot of people in industry, a lot of people in the financing also involved in making these policy decisions. Why is debt jubilee then so important? Because what are the alternatives?
Yeah.
So why don't we have a debt jubilee? What can we do to foster it? And what will happen if we don't do it?
I'm perhaps a little bit misunderstood. I'm not in favor of a debt jubilee. Because I think it may be very risky. Because our social and economic order is based on a number of things. One of them being that you ought to repay your debt. You ought to repay your debt. And it may well, if we now would announce tomorrow, for instance, that the right-hand side of this audience will pay part of the debt of the left-hand side of the audience, because the right-hand side has accumulated savings. This may upset the social and economic order. This may create a crisis that's far bigger than the crisis that we are in. So I'm not. I find it very risky. The problem is that the type of situation that we are in is indeed an issue of redistribution, and that's more a political than an economic problem. And trying to solve it by, like an engineer, construct a solution, I think misjudges, let's say, the character of a economic and political order. So I find it risky. I don't think that it will happen. I don't hope that it will happen if there is not a favorable ground for going in that direction. And the favorable ground can only be created by really a deep crisis. Where were debt restructurings successful in the way that they in the end improved the situation, for instance in Eastern Europe? But they stood with their back against the wall. If I look at the current Dutch environment, there's no way that you get consensus for doing something like that, and then it could be a very dangerous exercise. So it will not happen. In the Netherlands, it's not even necessary. That's my point that I made earlier. I will not elaborate on what will happen, the muddling through that we are in, and there may be a gradual recovery, but it may well be that we will have another 5 to 10 years of very modest growth. Is that a disaster? I will have to.
Michael Hudson put it beautifully in saying that the debts that can't be repaid won't be repaid. I had the caveat, we've got to work out how you're not going to repay them. Now, I think we have got a debt crisis globally, and it does apply in the Netherlands. From what I remember from the biggest figures, your debt ratio is 2.4 times GDP. America's 1.6. So if anybody's in a debt
simply not right. If you look at the net debt ratio in the Netherlands, we are a very rich country. We have a net surplus.
Exactly. Your net surplus is international, but your domestic debt level is 2.4 times your GDP.
Yeah, but that's the method to solve that. The method to solve that is not a debt jubilee. It's to think about a clever institutional solution where we can use the assets that we have
then you do that.
that.
I'm talking in favour of using that assets to cancel a large part of the debt. Because if you use the capacity of the government sector to create money, which it has, and use that to say people have to reduce their private debt levels and pay that to both debtors and savers, so you don't have the distribution issue you're talking about, you can reduce that debt level without penalising any particular group except the financial sector, where you reduce the size of their income earning assets, and that I think we need to do. But we are living in the biggest debt
gigantic redistribution because the government debt goes up.
Yeah, but the government has its own bank, except in Europe. The government has its own bank. Okay?
No, that's certainly not.
Okay. So we're quickly getting into operational details.
Yeah.
This is not. No. This is not an operational issue. It would be it's far more than operational. If we would increase, let's say, the money stock initially for the
It could actually make no difference to change
and then having some people having, let's say, an additional to their assets. What would happen to spending is very uncertain, may well create inflation. It increases government debt, and indeed in Steve's model that's irrelevant, but I think there's a high risk that it will undermine the integrity of the currency. It will create a huge moral hazard going forward. It will change the whole way of the functioning of the economy after you've done it.
Like, you can do it in small doses, and I'd rather do that than lead to large doses of what might happen in Southern Europe.
Yeah.
Okay, I think that
A number of
both the
small
case,
doses can kill a patient.
I think that both the case for debt jubilee and the case against it has been adequately made. I also have time for other issues.
Yep.
My name is Anneke Schroeter. I'm a student in math.
Good.
So the first
We need
question will
more.
be a mathematical one.
Yeah.
And have you ever made a cellular automaton out of your model? Because
That's
you can, and what did you learn from that?
Empirical fitting. I haven't done that.
And
Yeah.
the second question was actually about that, truthfully. It was about what can we do to get the spirit of 45 pretty much, because that has all the fairness and the growth that we want without getting the spirit of 40.
Sorry, I
Yeah.
didn't get that.
The spirit of 45 without the spirit of the 40s. Yeah.
Oh, okay.
Yeah,
So
no,
the first question is, Steve, can you do actual empirical
Yeah.
estimates instead of qualitative
Yeah.
theoretical models?
Cellular automatons.
Pardon?
Have you ever made cellular automatons of your differential equations? Because if you do theoretical biology or theoretical physics, you
Oh,
do
okay, well,
that.
if you, there's actually, Matthias Griselli is doing that right now, so there's
So
talk
that's the
about
first
the
question.
persistence, using persistence theory and things like that to say, what are the situations that will give you a sustainable system versus a breakdown? And yes, that's being done right now by mathematicians. So I'm delighted to see people like Matthias Griselli from the Fields Institute and a number of mathematicians now saying, let's look at this approach to economics, because before the crisis happened, they thought economists must have made a sensible decision that the best way to model the economy is equilibrium, and they simply gave them the mathematical tools. Then there was a seminar at the Fields Institute, which Matthias organised, where you had all these mathematical economists after the crisis, and Matthias would say, what do you think caused the crisis? And the best answer he ever got was, I don't know, what do you think? And he said, he went looking and said, did anybody talk about instability in capitalism? And then was recommended to read Kindleberger. Reading Kindleberger read Minsky, and then reading Minsky read me, and finally thought, well, this is a realistic approach to economics, and mathematicians need to extend that. So the type of mathematical analysis you're talking about is now being done by people like Matthias Griselli and Costa Lima and so on, and I hope it goes a lot further. And I'm trying to add to Minsky the capacity to do empirical fitting, Levenberg Marquardt fits and stuff, parameter estimation and so on, and working out the Lyapunov exponents and all that sort of stuff that is an essential part of understanding a complex system.
Lex can chip
Yes,
in on this as
I'm a
well.
great fan of cellular automata because I think it could be a step forward compared to the type of models that we have here, because we have cells, and the cells are people, and at the same time we have emergent behavior.
I missed your question.
And then I with the link between, let's say, individual behavior, the cells, and the emergent behavior, and I think that's what we need. That's one of the relative weaknesses of this model.
Second question.
Because we have emergent behavior, but not in the background, the operating cells or agents.
So I missed the detail of your question. If I've got my hearing to say that, I missed part of what
I
you
will
said.
repeat the second question.
No, the second question I got. The first question was about cellular automata, which is a bottoms-up technique.
Sorry. I want to cut short the discussion about cellular automata.
Just say that you agree, Steve.
Yeah, that's
Just say that you
great.
agree with me.
No, I actually did.
The second question here is. The second question is.
Okay. The second question is how do you get the spirit of 45, which is reconciliation and income for everybody and the welfare of the mass mattering more than the welfare of the elite. Whereas the period of 40 was the beginning of the Second World War and the aftermath of a totally elite-focused mentality, not just from Hitler in the 30s, but in the 20s as well, which gave rise to that mentality. And we're actually repeating that same philosophical pattern, which I think is quite dangerous. In my own country, in 1945, there was a white paper on employment written, and it's expressed with the spirit which was global at the time, so I'll quote it, and pardon the sexism of the document. It says, the objective of economic policy was to maintain such pressure upon employment as to guarantee a shortage of jobs a shortage of jobs, saying a shortage of men rather than a shortage of jobs. Okay? That was the orientation of the 40s. We've let that slip completely. Who cares about unemployment? Who cares about workers' income? That's all shifted. And we need to get back to those days when the philosophy is about making sure the majority of society has a decent standard of living. And that is a huge ideological shift because everything has gone towards the elite in the last 40 or 50 years. And ultimately, it's the poor who suffer first, but the elite suffer later.
I don't, I don't think that, I focus on the Netherlands now for a moment. I don't think that in the Netherlands you need to have such a climate. Because I think that the problem that we have in the Netherlands can be solved, as I said, by institutional changes. When you give people the opportunity to repay their debt with their pension savings. Because we have on aggregate, we have a very high savings ratio, and with a highly accumulated saving. That combined with normal bankruptcy law, and perhaps a little bit leniency there, I think can do the trick for the Netherlands. And people, there's not a feeling that we are in a very terrible and very difficult situation. It's not a crisis. It's not, in no way comparable to the end of the Second World War. In no way.
Okay. It's a 5:15, officially the end of the program, but we started 15 minutes late, so we'll also go on for another 15 minutes. If you do need to leave, please do it quietly. We're going to the next question here. Then there's one there, isn't there?
Just a simple one.
And
Oh yeah.
there, so 1, 2, and 3. Go ahead.
Okay, my name is René van Dal. I'm one of the contributors to your Kickstarter project.
Oh, thank you.
You're welcome.
Minsky was the extended, founded by INET and extended by Kickstarter campaign. One of my donors. Thank you.
One of your last slides was about real reform. Where do you think the real change will come from? Academia? Is it the students? In one of your recent video clips, you also mentioned businessmen.
Yeah.
Where do you think the real change will come from?
I hate to say it.
Repeat the question.
Okay, yep.
Where will the real change come from?
In economics. I think it will come, unfortunately, from right-wing populist politics. Okay. That's the scare that I've got. I think that we're likely to see a right-wing uprising in Southern Europe, whatever shape it might take, and the right-wing, the fascists, have no problem with breaking rules because they practice by breaking bones beforehand. So what scares me is that's where the change is going to come from. Where it should come from, I think, is the business community, because ultimately it's the business community which has been conned by this sort of stuff. It's the industrial capitalists have suffered by far too much debt accumulated over time, partly out of their own behaviour, as Dirk was saying beforehand, but we have to have a financial sector which is a servant of the industrial sector, not the master. And we have to restrain finance to the stage where it's required, which gives you the required finance capitalism needs, not so much finance that capitalism collapses under the weight of debt repayment, which is where it's got to. And that requires a realistic vision of capitalism, which actually would have looked at that debt to GDP ratio back in 1960 or 1970 and said it's getting out of hand, we've got to control the level of lending. Because we didn't do it, that's a major reason why we're having a crisis now. So the business sector is the group that should make that move for realistic economics, forget ideology, forget fighting the working class, etc., etc. We want to have a coherent understanding of capitalism because it's too complex to let it run itself and let the financial sector cause a chaos like it's done this time round.
Okay, any business people here? Okay, our hopes are on you. Thank you very much.
Dick van Elk, the remark about the amount of money we have available in our country, 1.5, no, 1,500,000 million.
1,500 million.
Sorry.
Yeah.
A lot. Yeah.
No, if you are able to spend that in the wrong way, in the old economics, we might end up with bigger problems than we have today. What if we should spend it in renewables, etc., and really make progress by using the money we already have, and we only need a part of that, maximum 1/3, to go to a renewable economy, which far differs from what we have today, and which also brings new perspectives where people can believe in again.
Thank you very much. So this is an issue which is very widely debated. Isn't the financial crisis a wake-up call, as they say? Isn't it an opportunity, or even does it not show the need that we should start spending our money, however much it is, in a more ecologically friendly way?
I think we should do that, and let me put it more broadly. I see this crisis as one of the biggest crises that perhaps capitalism has had, and like in the 1930s, we have to reinvent capitalism, as it were, and I think that's the way forward. The biggest mistake that we can make, I think, is to think about a revolutionary different system. Because again, capitalism has served us very well. So the wake-up call is to again use all the resilience that is in that system to go forward. And I think sustainability is one of the issues. And I think if you would like to have a sustainable economy and solve the problems that are there, I think the best guarantee for having that is having a really vibrant capitalist system.
Yeah. I think the one thing which could be the comparable thing to the Second World War would be finally fighting climate change on the same scale. Again, if we find that we actually are melting Greenland, or that the methane fields of the tundra are about to explode with pumping methane gas into the atmosphere, that might finally inspire us to spend in the same unrestrained way we did during the Second World War, because nobody's going to say we can't afford a budget deficit if the alternative is, the Netherlands is 12 metres below sea level. So that I think is, certainly we could do it, but what worries me is the political will. And again, only if we see it's absolutely inevitable, I think, does humanity actually react to something like that. And so far, because it can't be proven to be totally inevitable yet, we won't do anything until after it becomes inevitable. And then, of course, people will say, why didn't you warn us beforehand? It's humanity's nature.
Question here.
My name is Peter Verhaan. More or less a representative from the banking sector.
Yeah.
You were mentioning that that banks shouldn't extend credit to people who can't afford to repay the debt.
Yeah.
So, in my point of view, commercial banks should only extend credit to companies. And why don't we leave the mortgage sector to specialized banks, which are fully funded by savings, by equity?
Yeah.
Wouldn't that be a solution to?
Yeah, I think something like that.
The big fluctuations.
Yeah, something like that is a sensible thing. Because,
sorry.
Yeah.
The question here is a representative from the banking sector.
More or less.
More or less than more.
Is the gentleman in the blue suit?
I used to own a bank.
And he said maybe we should have a fully funded equity-type mortgage banking sector, and real banks, so credit-creating banks, real banks should only lend to companies.
Yeah,
Steve,
I think that's something like that is sensible. That was used to the idea. That was the idea of Glass-Steagall, to separate commercial banking from retail and so on. And the savings and loans were limited in what they could do as well. Reagan actually, you see Reagan signing the abolition of the constraints on savings and loans. He said, "This is going to cause a revolution," or "Boy, is this going to cause change?" Well, he did. It caused a catastrophe back in the 1990s. So limitations like that that stop. That keep commercial banks supplying to businesses and having another institution supplying for housing, for household credit is sensible. We should actually have structures like that in finance and have walls that prevent that speculative excess pouring over into the household sector and then causing bubbles. I'd also be in favour of banning margin debt, for example. I think that is a major contributor to stock market bubbles. So we have to have those walls and limitations on what the finance sector can do.
Before we rush to split up the Dutch banks, I'm not so sure. To put it mildly. it would not be a new situation. We have had mortgage banks in the Netherlands. We've had them worldwide. And if you look in history, where the crisis came from, it's in many cases it's real estate. It's real estate, and it's exactly, let's say, in the type of institutions. If you want to resurrect, so they are not a fire-safe protection. That's what history tells us.
Okay. 1, 2, and 3. Theo.
Ja.
Stand and who you are.
Theo Kokker. Steve Keen is the 80-year later version of Irving Fisher. You have a computer, but you.
I didn't blow $100 million like.
And you didn't make the same mistakes as Irving Fisher did, and that's why you still have some money.
Not much. An academic after all, an ex-academic.
Theo, what is your question?
And make sure, Dirk, make sure you repeat it.
He will make his own speech.
No. So 80 years after Irving Fisher, you come up with the same ideas, and but you warned before the crisis, not after the crisis. But I'm very pessimistic about the periods of tranquility, and that we will again forget about this theory and what Galbraith calls the financial amnesia. So how can we ever avoid financial amnesia? Because this science doesn't learn. It made the whole private debt even worse than in the 1929s. So how can we learn if we become overconfident and make even bigger mistakes?
Yeah.
So what Theo is worrying about is that maybe when we get back to normal, as you think we will go naturally back to normal, we will forget about the dangers of financial capitalism and end up with the same crisis in a couple of decades from now. Steve, what do you say to that?
Well, I think that's quite a legitimate fear, which is one reason why I don't rely upon regulators to try to control it, because we had regulators who really were enforcing conservative behaviour by banks back in the 40s and 50s, and they gradually, over time, you got new regulators replacing them who hadn't experienced the crisis. It's amazing how fast we forget, because we sort of talk about having a collective human history. Somebody who's 10 years younger than you doesn't know the most important crisis in your life. That's all it takes before we forget these things. So we can't expect to be able to control it and not have that amnesia strike again. The only way to actually have some chance of success is to stop the process happening in the first place, which is why I want controls like I call the pill for property income limited leverage, to stop the bubble that occurs in house prices out of rising levels of mortgage debt, and to have a negative feedback loop between levels of debt and house prices. And that sort of thing would then mean you don't get the rising debt, and that's what fuels the amnesia, because you then get a situation driven by a debt bubble, which looks like it's all fantastic, everybody stops worrying about debt, bang, crisis. So you've got to stop the feedback process in the first instance, otherwise amnesia will yet again apply.
But if there would be a pill law...
Excuse me.
Oh, sorry.
First of all, Dirk, I do not say that we will, let's say, naturally silently go back. No, not at all. And I think there will be, the financial system and the economy will be different, let's say, in 2017 than it was in 2007. And we can try to remove some of the imperfections, but it's inherent in the system. The system is inherently unstable, a market economy. So will it happen again? Yes, it will happen again. And we cannot we cannot unlearn gravity. We cannot unlearn the impact of uncertainty. So there will be cyclical fluctuations, and periodic financial crises are inherent in the system that we have. It's a byproduct of the very positive thing that it is the biggest generator of progress that we have stumbled upon. But it's not perfect. It's a bad system, but there's no better system discovered yet.
But we're talking about improvements.
Sorry, there's a question here. So it's 5:30 almost, so here's the last question, and then over drinks we can... Sorry, there's 2 more questions. Apologies. And then over drinks we can continue.
My name is Mark Sanders, Utrecht University. I wanted to come back to the debt jubilee and also about preventing bubbles from emerging because of debt finance. I think what could be done, I mean, you say you ought to repay your debt. That's a moral, cultural statement that you can have a big discussion on whether that is historically an inevitable truth to be adhered to. And I think if we redress the balance between...
Mark, what is your question?
Yes, I was getting to that, Dirk. If we redress the balance between the debtor and the creditor, and who's responsible for making that contract, I mean, they are both involved, so they should both be 50% responsible for the contract being served, yes or no, then that gives you a different perspective on the debt jubilee, and it also reduces the incentives to overland. It's more of a comment, but I would like to see the response.
So the idea is if we let the pain be shared between debtor and creditor rather than an outright debt jubilee, or as we do now saying a debt is a debt and it needs to be repaid in full, can't we strike a balance?
This is a very nice example of what Hayek calls constructivism. The idea that you can reconstruct an ethical, a legal system at will, that you can engineer it, as it were. You're right that if people would agree on that, we would have a different world. But it's very deeply ingrained cultural things, and you cannot simply arbitrarily change that. That can create a lot of trouble.
But it's a cultural thing that wasn't the cultural thing, you know, some decades, some centuries ago. And it's also part of the cultural thing is nobody ever complains, nobody says to a company, I'm sorry you can't go bankrupt. Okay? When a company goes bankrupt, that's it. You can record the debts and say you've got to repay the debts. The company doesn't exist anymore.
Yeah, but that's also true for persons.
Which is why maybe we should extend that to people. The debt, not that they disappear, but that their debt can be disappeared. But when we have this total belief that it's all the fault of the debtors for taking on too much debt, we're ignoring the fact that creditors did push debt during the last couple of decades. And when you had banks lending with the ninja loan, no income, no job, no assets, that's fraudulent. Now, we are not, I thought, in the business of defending fraud. But fundamentally what we're doing by saying you must pay that debt back is saying you must pay a debt which was fraudulent in its nature in the first place.
Yeah, but we have debt, personal debt rescheduling rules and regimes. What is asked for here is something very different. There are people arguing here, for instance in the Netherlands, that people that have a mortgage that's underwater should be subsidized to reduce that. And should be helped to repay that, to reduce that debt. Whereas they still have the capacity to pay. And they can simply pay.
Okay,
so
this is going to continue over drinks. We go to the last question.
My name is Marcel de la Fontaine. I'm doing also research work on the same subject as Steve Keen is doing. And Steve, we already discussed a little bit about the remarks I have, serious remarks I have at some of your simulations. And I would like you to comment on that. And secondly, do you think that it is limiting that you have a very, very simple model of the real economy, which you're using in combination with the monetary issues you have?
Yeah.
So the question is, the model that Steve presented is simple, perhaps it's too simple, especially the real economy model. Final comments.
One of the lessons of complexity theory is that a very simple system can give you very complex behaviour. So, and the fact that the model captured those two elements of reality, a tendency for declining cycles followed by a debt crash, speaks in favour of simple models. I actually want to have more complex models, to have a more complete vision. That's why I built Minsky with that capacity to include the financial sector and all the structures there, and the intention is to be able to handle multiple sectors and handle multiple countries as well. So I want to move in that direction. You have to start somewhere, so I started simple. This also raises a bit about your question about cellular automata. What I'm doing is a top-down modelling approach. Things like cellular automata and multi-agent modelling and so on is bottom-up. And the issue, I think it's a useful contribution. I've got a PhD student doing that right now. But to me, one of the difficulties of that is that we don't necessarily know the individual interactions of agents that gives us the emergent properties we see from the macro level down. So I think we need both techniques, and I'm pleased to have so little amount of being done, but it's, I think, a lot harder to get the definitions right of the agents and the interactions to get the macro level data we see than to start from the macro level down and model in a system dynamic sense.
Okay, we've really used up our time. Please give our contributors a hand.